My ETF-only portfolio is built around three core holdings: VOO tracking the S&P 500, QQQM tracking the Nasdaq 100, and the dividend-focused SCHD. Depending on economic conditions, I adjust their weightings to play both defense and offense. The goal is simple: minimize risk while maximizing returns. But today, I want to share with you one little known ETF that does exactly that automatically. It's passively managed, yet it has consistently outperformed the S&P 500 for the past 10 years by a wide margin. Beating the market, lowering risk, and still being passively managed. Can a single ETF really do all three? You heard me right. That ETF is SPMO, the Invesco S&P 500 Momentum Index ETF. In this video, I will explain what SPMO is and why it should be an important part of any ETF portfolio, and how you might allocate it alongside your forever hold ETFs. This channel is all about investing, personal finance to help you retire early. Before we dive in, I want to thank one of my subscribers who introduced me to SPMO. That gave me the chance to investigate, and now I'm sharing what I found with you. So how does the S&P 500 Momentum Index work? At a high level, it calculates the 12 months return of every stock in the S&P 500, then adjusts for risk by dividing that return by the stock's daily volatility or standard deviation. In other words, if two stocks had the same return, the one with lower volatility gets the higher momentum score. The index then selects the top 100 stocks with the highest risk-adjusted momentum scores and assigns weights based on market cap. It rebalances in March and September, repeating the same process every 6 months. Now let's take a closer look at SPMO. It tracks the S&P 500 Momentum Index with an expense ratio of 0.13%. That's higher than VOO's 0.03%, but much lower than many actively managed ETFs like FundStrat Granny Shots GRNY at 0.75%, or covered called income funds such as SPYI at 0.68%. Its top 10 holdings include some of the well-known names: Nvidia, Meta, Amazon, JP Morgan, and even high-growth AI plays like Palantir. Because of this mix, it currently pays a modest dividend yield of 0.78%. The fund is broadly diversified, but technology, financials, and consumer discretionary make up about 58% of its weight. Since launching in 2015, SPMO has averaged more than 18% a year in total return, compared to S&P 500's over 14%. Cumulatively, that's a 362% gain, well ahead of S&P's 224% without considering dividends. And so far this year, it's already up 23%. SPMO is currently more volatile than the benchmark, with a higher beta of 1.27. That's mainly because of its growth-focused holdings, but that's not always the case. And it's exactly why I said earlier that SPMO can actually help reduce risk compared to the benchmark. To see how, let's look back at 2022. It was a tough year for the market. The tech-heavy QQQ dropped more than 32%, but SPMO held up much better, falling only about 10%. And it also beat VOO, which was down 18%. According to S&P's 2022 performance report, the fund was overweight in energy and healthcare by 25% and 15% compared to the benchmark, and it was underweight in technology by 23%. Then in 2024, a strong up year, SPMO outperformed once again, delivering a huge 46% return versus VOO's 25%. This time because it was overweight in technology by 19% more than the benchmark. So now you can see how SPMO really works. Every 6 months, it reselects the top 100 stocks based on 12 months returns, keeping the winners and letting their momentum continue. In downturns, when investors move to defense, the fund naturally rotates into value and dividend-paying stocks, just like it did in 2022. When the market flips back to offense, it shifts into growth names, as we saw in 2024. In short, SPMO plays defense when the market's down and offense when the market's up. This is exactly what I've been talking about in other videos, how to manage your portfolio by rotating between growth ETFs like QQQM and dividend ETFs like SCHD. The difference here is that SPMO does that rotation automatically for you. That's why it has been able to outperform the benchmark whether we are in a bear market or a bull market. That said, the strategy isn't perfect. In transition periods, when the market shifted from down to up in 2019 and then again in 2023, SPMO lagged the benchmark. The reason was its 6 months rebalancing delay in switching the fund back to growth mode. But once the bull market kept going, SPMO caught up quickly and pulled ahead. Similarly, if the market begins to shift into defense mode, growth names will likely fall first, making SPMO vulnerable until the next rebalancing cycle. These are the risks investors should keep in mind. As I always do in my ETF videos, let's step back and look at the big picture. Why this fund stands out among more than 4,000 ETFs in the market. Its success comes down to 3 big forces that drive SPMO's performance and explain why momentum works so well. First, SPMO follows where the money goes. It only selects high-quality S&P 500 companies, and more than 80% of them are large or mega caps worth at least $10 billion. It takes massive institutional money to move stocks of that size, and institutions usually stay invested longer. By weighting its holdings by market cap, SPMO emphasizes companies with strong institutional backing, the big money that drives momentum and provides staying power. Second, smart money follows business fundamentals. Institutions don't put billions into stocks without reason. Strong momentum usually reflects a real shift happening inside the business. It could be a major industrial trend like the AI boom, a new product breakthrough taking market share, or even a turnaround story. Whatever the reason, stronger fundamentals eventually show up in stock prices and are reflected in the momentum scores. Finally, there's the macro factor. If you look at the US economy over the past 30 years, GDP growth only dipped significantly 3 times: after the dot-com bust, during the global financial crisis, and during COVID. The rest of the time, the economy kept expanding. Because the stock market reflects the US economy, bear markets have averaged only about 9 months, while bull markets typically run close to 5 years. And under this backdrop, momentum strategies excel. The longer the bull market lasts, the more SPMO's returns are amplified. So how do I fit SPMO into my ETF-only portfolio of VOO, QQQM, and SCHD? First, SCHD still serves as my income-focused ETF. It offers growth above inflation while paying me more than 3% in dividends. And as the Fed begins cutting rates, it will soon be more attractive than CDs. So I'd put 10% into SCHD. Next, 15% goes into QQQM for growth, 30% into VOO as my core foundation, and 40% into SPMO. Last, I would keep 5% in cash for flexibility. This way, as SPMO rotates its holdings between growth and value, my portfolio adjusts automatically, shifting between offense and defense, giving me a better chance to beat the benchmark without active management. Now you might ask, if SPMO is so good, why not just make it my only ETF? Well, SPMO is still relatively young compared to the others. I'd like to see how it performs through a major boom and bust cycle like the global financial crisis before assigning it a larger weight. And by keeping the other 3 ETFs, I leave myself an option to adjust allocations manually if needed. If your priority is stability and income rather than growth, you can increase SCHD's allocation in your portfolio. That's all for today. Keep your questions and ideas coming. I'm always looking for new ways to refine my strategies and share them with you. Happy investing!